Swayam Prabha. Digital India. Educated India.
Hello and welcome to this session, which is part of the course Economic Environment and Business Strategy. So in this and the upcoming sessions, we will turn our attention to the financial environment, an essential pillar of any modern economy and a critical factor shaping business decisions. We will begin by understanding the structure of financial markets, how they connect savers and investors, and the ways in which capital is allocated. We will explore the major type of financial instruments such as bonds, equities, and derivatives, and how they serve different purposes for financing and risk sharing and investment. Next, we will look at financial intermediaries, institutions like commercial banks, mutual fund, insurance companies, and that play a vital role in channeling funds and managing risk in the system. So in the later part of this module, we will discuss the theories of interest rate determination and explore how credit ratings influence borrowing costs and capital access for firms and governments. So this understanding is not only central to business strategy, it's also crucial for interpreting broader economic trends, policy changes, and financial stability. So let's begin understanding what the financial system does at a fundamental level. So the financial system serves a simple but powerful functions. It channels funds from those who have surplus savings, that is here lenders, those who have surplus fund, to those who are in need of funds to invest or spend, such as business firms, government, households, and foreigners. So this process of fund flow can happen in two ways. One is called direct finance. So in the case of direct finance, the flow is like this. Shows at the bottom of this diagram occurs when lenders, those with the surplus funds, lend directly to the borrowers through financial markets, for example, purchasing stocks or bonds. So the channel look like here. This is the lender side, and the funds go to the financial market, mainly bond market and equity market. And then those who have surplus fund, these funds, it will go to the needy, that is the business firms when they issue bonds or when they issue stocks. Similarly, government when they issue bonds, and similarly households if they want to directly buy, and mainly in case they can buy bond issued by corporate and governments, and foreigners also can buy this fund. Second one is this is shown at the top, involves financial intermediaries. That is the key difference here. Here financial intermediaries come in the picture. So like banks, mutual funds, or insurance companies, these are the financial intermediaries who act as middlemen here. This is indirect finance. So they collect savings from multiple lenders and channel those funds to the borrowers or investors. So this intermediation is especially important because it reduces risk, pools resources, and often helps overcome issues like asymmetric information between borrowers and lenders. So now, why does this matter? So first of all, promotes economic efficiency. So I have written here the economic efficiency. It promotes economic efficiency by ensuring that capital flow to its most productive uses. Government can invest and innovation can be financed, and all of which contribute to greater output and economic growth. So in other words, the savers, those who have surplus funds, they have surplus fund, but they are not aware of the best or the efficient utilization of the resources. So they lend this money to those who can make the best use out of them. So then second, it improves consumer well-being. For example, consumers can borrow today to buy a house or fund education and repay over time, aligning financial flows with their life cycle needs. So in short, an efficient financial system is critical to both economic growth and personal financial planning. And understanding how these flows work is the first step to grasping the broader financial environment. Then moving to the next step aspects, that we have seen how funds flow from through the financial system. Let's break down it into 6 key components, each playing a distinct but interconnected role. The first one is money. So money is the foundation of any financial system. So it serves 3 essential functions. It acts as a medium of exchange, it serves as the store of value, and also is a unit of account. So without money, the modern economy wouldn't function. It simplifies transaction and enable us to measure and compare value across time and space. And then the second component is, another integral component is financial instruments. So financial instrument, these are the contracts or claims that help transfer funds from savers to the borrower, and importantly, transfer risk to those best positioned to manage it. For example, it includes deposits. I have given a couple of examples here, listed a couple of examples. Deposits, loans, bonds, stocks, insurance, mortgage, etc. So think of them as tools for channeling resources and managing financial uncertainty. Then moving to the third component, these are called financial markets. So these are the platforms, be it physical or virtual, where financial instruments are bought and sold. So they facilitate, they enable price discovery, liquidity, resource allocation. So examples include New York Stock Exchange, Bombay Stock Exchange, and even the modern electronic trade platforms. Then moving to the fourth component, these are financial institutions. So these are the intermediaries that connect savers and borrowers and provide access to finance markets. So they also collect information about borrowers and help reduce transaction costs. Example here, banks, mutual funds, insurance companies, and security firms, they are the key examples here. So then moving to the fifth element component, these are government regulatory agencies. So one of the objective of government regulatory agencies is not only to develop the financial system, but also to regulate the financial system, because a sound financial system is the backbone of any economy, because it channelizes those who are having surplus and to those who need this fund, who can make the best, that is efficient use of these funds. So in this case, government regulatory agencies play a pivotal role. So these institutions, the government regulatory agencies, they ensure that financial system operates safely and reliably, so that the general public having the financial system, and they channelize the funds to the productive sector through the financial system. So keeping this in mind, the government agencies, regulatory agencies, they set rules, supervise participants, and set act when market discipline fails. So in India, these include Security and Exchange Board of India, that is SEBI, IRDI, Insurance and Regulatory Authority of India, and Reserve Bank of India. So these are the key regulatory agencies in India who ensures that the insurance market, the security market, and as well as the banking system works efficiently, and it helps them to develop, grow efficiently. At the same time, it regulates as well. Then moving to the last but not the least element, that is central banks. So finally, central banks, like for example, Reserve Bank of India, they play a pivotal role in stabilizing the financial system. So they manage money supply, they control inflation, and act as lenders of the last resort during crisis time. So together, I have given some examples also here. In India is Reserve Bank of India, and in the US is called the Federal Reserve System, the central banking system in the US. So together, these 6 components form a dynamic system, not only channels funds but also maintains stability, supports economic growth, and allows businesses and households to manage risk. Let's now move to another component, that is called the core principles of financial markets. So turning to some of the core principles that financial markets, it helps us understand why financial system behave the way they do, and why certain patterns like risk premiums or interest rates emerge across time and geographies. So starting with the first one, the first core principle is time has value. So this is one of the most fundamental concepts in finance. A rupee received today is more valuable than a rupee received in the future, because today rupee can be invested to earn returns. So that's why interest rate exists. It compensates for delaying consumption. So you need to know that sometimes the households, when they get their income, they allocate their income in a way that their total disposable income, they allocate it into consumption and savings. So when the saving goes to the finance market, so that means they actually, what does it mean? That saving is nothing but they're foregoing their present consumption, because the ultimate objective of having income is to satisfy our wants and needs and wants. So that means consumption is the present one, saving is in fact we are postponing the present consumption to the future. So in order to do that, in order to incentivize that, they need a return. That's why they are getting a profit or interest rate income. So it's mainly because time has value. So this is one of the fundamental principle in finance market. Then second one is, another important principle is, risk requires compensation. So investors don't like uncertainty. So if they are going to bear risk, say investing in a startup or volatile stock, they expect to be compensated for it. So this is why higher risk assets typically offer higher expected returns. So the more risk you take, the more you should be rewarded. Suppose if you are investing in a high risk bond issued by a corporation, then that is the case, you need to get higher reward. At the same time, if you are going to invest in government security, that means you are fully assured that you will get back your income back, then obviously your risk is less, then you will be rewarded less. That means you will be getting less return. Then moving to the third principle, that is called information is the basis for decisions. Information play a key role, critical, it's very critical in the smooth working of financial market. So markets run on information. Investors, lenders, and borrowers all depend on timely and accurate information to make decisions. So the more transparent and accessible the information, the more efficient and fairer the outcomes in financial markets. Then moving to the fourth principle is markets determine price and allocates resources. If you see the market mechanism work, for example, demand and supply, it works mostly in the finance market. Unlike other market, it is the finance market where we can see the efficient working of demand and supply, that is the price mechanism. So in a well-functioning market, prices reflect both demand and supply of financial instrument as well as all publicly available information. So these prices help allocate resources like capital here. The resource means capital to the most productive opportunities in the economy. So then moving to the next principle, that is called stability improves welfare. Financial stability matters. When markets are stable, uncertainties reduced, investment flows more smoothly, and consumers and businesses can plan better. That is, consumers and businesses, they can plan better. So that is why central banks and regulators play such important role, and they help ensure confidence and reduce the risk of systemic shocks. So together, these principles form the conceptual backbone of modern financial system, and they guide both market behavior and policy making. Having said this, let's now move to the components, three essential components of financial system. So it mainly, we list out here the core components of the financial system that we will be discussing in detail across this and the next lecture. So we will start by understanding the structure of financial markets, that is how they are organized and the roles they play in connecting, talking about this one, in connecting savers with borrowers. Then we will move on to the next component, that is types of financial instruments. So the various contracts and the tools used to transfer funds and manage risk, such as bonds, stocks, and derivatives. And finally, we will look at the type of financial intermediaries, institutions like banks, insurance companies, mutual funds that facilitate these financial transactions. So together, these elements provide the foundation for how modern financial system function, and understanding them is essential for analyzing strategy in any economic context. So moving to the first part, the structure of financial markets, we can classify the financial markets into debt and equity markets. So debt and equity markets here means mainly the debt market means is mainly the investors, they get their money returned back, their principal and interest income they get back at the end of the maturity. The debt market mainly include bonds, loans, and mortgages. So this also can be classified as short term and long term. So there are short term loans and mortgages, and as well as there are long term as well. In between there are medium term as well. So an important feature of debt market is that it provides fixed returns over a defined period of time. For example, if you buy a bond, so you will be getting annual rate of interest. Similarly, if you are giving a loan to someone, then you will be getting a periodic return for these loans. So that means it provide a fixed returns over a defined period of time. Then moving to the next one, that is called equity market, and here the return is in terms of dividend and as well as the changes in equity price, that the capital gain. So equity markets are primarily a market for stocks. So it provides a stockholder. Stockholder means actually you are a shareholder of that company. So it provides a claim for you on the net income and assets of the company where you invested, the firm where you invested. And as you are aware that there are higher risk, but because of, in order to compensate the higher risk, in general you will get potentially a higher return when you invest in stocks. But you know that risk is also very high. Sometimes you earn very little, sometimes you lose your investment income itself. So that is about the equity markets. So when distinguishing between debt and equity markets, the key difference is that when you buy a bond or when you lend someone, so you are a debt holder, so you have a priority claims on assets and income in case of default. Suppose just look like a firm, for example, assume that it issued bonds, that is the debt, and also it issued stocks. Suppose you bought debt, the other person bought his share, then you have the first claim, you have the priority claims on the assets and income in case there is a default by this firm. Then only the equity holder come, that the equity holders are residual claimants, whatever is left over in case there is a default is there. The first claim is for the debt holders who gave the debt loan. The second one, the residual claimant is mainly the equity holder. That means if you have a share in a company, you will get only secondary preference. Say residual claim, you are only a residual claimant. That means the resources, those who gave the loan, those who bought the bond, they have the priority claim on the assets and income of the company in case there is a default. Let's also make a distinction between primary and secondary equity markets. So primary market means where new securities are issued for the first time. So normally firms raise capital directly from investors through primary market, and it often involves underwriting by investment banks and issuing initial public offering, that is IPOs. So once especially stocks, IPOs are issued, you know that after some points, a few weeks, it will be listed in a secondary market and it will be transacted in the secondary market. So secondary market means involves the trading of already issued securities. That means which is already issued in the primary market, which one is already issued in the primary market, that will be transacted in the secondary market. At that time, the firm is not in the picture because the transaction is between those who want to sell the share and those who want to buy. So at that time, it is just between buyer and seller. At that time, firm is not going to earn here. Because firm, they raise capital directly through the primary market. Secondary market is for already issued stocks and bonds. So the BSE, Nifty, these are all secondary market. It enables investors to buy or sell existing shares. So it includes mainly stock exchanges and over-the-counter markets. So mostly the secondary market, stock exchanges are facilitated by brokers and dealers. So then a critical question is that what is the relationship between primary and secondary markets? So here a well-functioning secondary market, that means if the securities that is issued in the primary market, it can be transacted in a well-functioning secondary market. It ensures liquidity, price discovery and investors' confidence, encouraging participation in the primary market. That means if the secondary market is working efficiently, then there will be existence of primary market as well. If there is a strong secondary market, that means there will be a strong primary markets as well. So furthermore, firms with strong stock performance can command higher IPO prices from the primary market, helping them raise more capital directly. So a vibrant secondary market thus supports and strengthens the efficiency and success of primary market issuance. So To summarize this one, the debt and equity markets, trade involves actual finance claims, bonds and stocks, and transactions are settled with immediate cash payments. But in the derivative markets, trade involves contracts based on underlying assets, and instruments include futures, options, and swaps, and primarily used for risk management or speculation. So let me now show you a summary table showing the comparison of financial markets and instruments. So I have summarized this in a tabular format. You can see the market type. It is presented as market type separately for debt market, equity market, and derivative market. And then I have given the definition here, and the key characteristics are listed here, and also the examples are given here. I hope that this table would help you to understand the financial markets and in instruments in a better way. So about the derivative markets also, I have given the types of derivative markets here. So there are three primary instruments here. One instrument is futures. What is the definition? I have given the definition here. The settlement is given here, and the purpose is also listed here. Then options and swaps. So then we have money and capital markets. So the money markets mainly deal in short-term debt instrument, that is less than 1 year, whereas capital markets deal in long-term debt and equity instruments, which is more than 1 year. So debt securities, cash equivalent, that can be interchangeable in the case of money markets. So the money markets is primarily used by governments and corporations to keep their cash flows steady and for investors to make a modest profit. So at the same time, capital market means companies that issue stock and long-term bonds to do so for the purpose of raising money for their long-term operations. So let us, to sum up, the financial system plays a vital role in connecting savers and borrowers, enabling efficient flow of funds across the economy. It consists of key components: money, markets, and instruments, intermediaries, regulators, and central bank that work together to support economic growth and financial stability. So understanding how different markets operate, debt, equity, and derivatives, helps us appreciate the risks, returns, and roles they play in capital allocation and risk management. So ultimately, a well-functioning financial system promotes economic efficiency, supports investment and innovations, and improves overall welfare. Thank you for watching this session. Careful attention to this content, and see you in the next session. Thank you.